Good morning, everyone, and I would like to join my co-speakers and welcome you all here this morning. As you can see, and as you know, the theme of today's conference is Ready, Set, Retire, and I see myself as now taking over the baton in the relay race to financial sufficiency in retirement, and it's my job here today to discuss the tax leg. Now, I know tax is not everyone's favorite subject, and I was actually thinking, and actually amusing myself recently, and I was thinking that if I had to create a new dictionary definition for tax, it would actually go something like this. Tax is a three-letter word known to cause anxiety, shivers, hysteria on occasion, rivers of perspiration and grimaces of discomfort, unconnected with any known bacterial or viral infection, and usually used by conference speakers in the same sentence as the only thing one cannot avoid in life is death, taxes, and change. Sound familiar? Okay, but in fact, what I'm going to show you here today, that in fact tax is not an unfriendly word, not in the retirement planning environment. Tax is in fact a very useful tool in tax planning. And just like any tool, whether it's an appliance in your kitchen or in your garden, one just needs to be shown how to operate it. Now, on my agenda today, I think I've just gone back. Okay. I'm going to be dealing with what exactly is tax planning and retirement, why it's useful, why it's important. Then I'm going to be dealing with taxation in retirement funds. I think most of the people here are members of retirement funds, and there's also a great deal of change happening in the retirement fund environment, which I'd like to discuss with you, and especially in the tax aspects. And there's a whole new landscape for contributions, which is coming about on the 1st of March 2015. And although I can't go into it in a great deal of detail, I would like to just give you a snapshot of what's going to happen. And just as an aside generally today, okay, in my limited time, I can really just give you an overview of the tax. And that is why I believe it is just so vitally important to always have a financial advisor at one side. I see it as a financial coach. Just as you would go to your doctor or your dentist for a financial checkup every single year, I believe you go to your financial advisor for a financial checkup. Okay, you wouldn't cut your own hair. You wouldn't do something as simple as that. So why do this very important role of retirement planning all on your own? And later on, in terms of more questions, please SMS some questions to us for the panel discussion. Okay, then I'm going to deal with another really important aspect, which is those of you who are going to be coming up to the decision of retirement. Okay, you'll be asked this. You'll have to ask yourself this question: do I take more lump sum, or do I take more income? And then we'll be dealing with retirement funds extensively, but is that the only way to save for retirement? Or should one be supplementing one's retirement savings with after-tax investments? Okay, when I say after-tax, in my environment, what I mean is that you don't get a tax deduction on those contributions. So now, just generally, what is tax planning for retirement? What it is just within one's overall investment strategy. Okay, one needs to make sure that you are taking advantage of the tax opportunities that the state is giving one, that is just inside different kinds of investments. The state gives us incentives to save for retirement. Why? Okay, for two reasons, actually. It is the state's job. It's their job to make sure that we are not vulnerable in retirement, that we are planning ahead, and that we make provision every step of the way. But in addition, it's self-serving for the state. The state wants to make sure that we don't have to rely on its facilities when we get to retirement, like the medical system, etc. The state gives us incentives for sufficient income. It doesn't give us incentives for lavish income. And that's why you will find that within the tax opportunities, there are limitations, which we will discuss. But as I say, it is so important to use these tax opportunities. During the years that we're all trying to plan our families, educational expenses, medical expenses, paying off home loans. It's wonderful if for every rand we place into a retirement fund, depending on our tax rate, the state can contribute up to 40 cents of every rand. Now, that is something that shouldn't be neglected. Okay, now there's also an age-old question. Should one save for retirement only through retirement funds, where one's getting tax-deductible contributions? Or should we actually use other kinds of investments, your after-tax investments, your discretionary investments? Now, my opinion is you actually need a combination of both. Because in retirement, you actually find that your after-tax investments, where you didn't get a deduction during the planning, usually have quite a low rate of tax in retirement. And if one is actually reducing one's rate of tax in retirement, then the effect is that you have more disposable income in retirement, which is really the name of the game. And also, I think it is a reality check to understand that pensions are an incredible springboard. Most of us in this room would really, in those years when we're trying to finance other things, struggle without having that at retirement. But as John said in his presentation, the realities of life are that people have around 7 jobs in a lifetime. And often in one's early years, you saw that video, when people are young, they don't think about retirement, and when they leave a job, they don't preserve. So in many situations, only maybe the last 10 or 15 years of one's retirement fund is what they will live on in retirement. So one has to, during the years that one has a little more disposable income, start thinking about those after-tax investments. Now, although I always say you shouldn't let the tax tail wag the dog, okay? Tax is just one aspect. I think this just might be a little bit of good advice that we can give our youngsters. And in fact, it reminds me of my own son, okay? He's actually doing a BCom, he's in 3rd year, and this year he was deciding on his subjects and he wanted to take marketing, and I said to him, no, you must take tax. And he said to me, but why? And I said, well, you know, it's good sound advice that tax is part of every commercial transaction. So, but what I really wanted to say to him, which I didn't say, is that if you take tax, it's part of every commercial transaction, and then you might get a job, and then you might leave home, and then you might not live on my retirement savings for the rest of your life. But, you know, they actually say that my generation is what is called the sandwich generation. Okay? The reality is that our parents didn't do enough saving, our children never seem to leave home, and we're in the middle. So, okay, now I want to take you into our retirement fund system. Okay, our retirement fund system is premised on principles where we call it EET, exempt tax. And if you look at that slide, you'll see that the first E for exempt is your contributions. Contributions, you get tax deductions up to certain limits. Then the second E is exempt in the fund, a wonderful opportunity, tax opportunity for contributions to be going in gross of tax, and then the growth on those contributions to build up without any tax, a huge benefit. And then the T at the end is, yes, you get taxed at the end, okay? But is that such a bad thing? Are you just getting contribution deductibility to get completely taxed at the end? So is it just a delay? And the answer to that is no, because in fact we have a hybrid system. Lump sums are taxable according to certain tables, and there is a certain amount of tax-free money and low-tax money you can get out of that. Compulsory annuity income, your pension in retirement, is taxed at your maximum marginal rate of tax. Okay, but what I'm going to show you later on in this presentation, and the good news, is that one's tax rate in retirement is actually far lower in most cases than it is during one's working years or at retirement. And that is why it's going to be a really big decision as to how much lump sum you take and how much you take as an income at retirement. But I want to go into now contribution deductibility, because as I said to you, we're in a state of change on that. Okay, if you look at that slide, it'll show you, and a lot of you are in the system already, so you probably already know it, that our current system is actually quite complicated. We have different deductions for different funds. If you're in a pension fund, there's one deduction. The employer can get 20% as of your remuneration as a tax deduction, and you can get 7.5%. But if you're in a provident fund, you don't get a deduction, only your employer gets a deduction. And then we have a retirement annuity fund, where the deduction is limited to 15% of your non-retirement funding income. And non-retirement funding income doesn't include the salary that your employer bases its contributions to your fund on. Okay? So look how complicated. Okay? So the intention is that this is simplified. Now, an important point about the fact right now, what you can't do, which in most cases people can't do, is that if your employer is using all your remuneration as a basis for contributing to your pension fund, you no longer have any non-retirement funding income left for your retirement annuity. Now, the good news is that in the new system, this is all going to change. Okay? As I say, change actually heralds, in most cases, good things. What we have now is that the deduction is going to be increased to 27.5% of remuneration or taxable income, whichever is the greater, for all different kinds of funds, for every fund, retirement annuities, pension funds, and provident funds. There is a limitation for people with high levels of income, that the deduction is capped at 350,000 Rand a year. Okay? In your pension and provident fund, the 27.5% does include the cost of life cover and costs, but there's still a good amount that can be contributed for retirement. And the good news on things like retirement annuity funds is that if, for example, your employer is contributing, or you, in fact, in this environment, are contributing, say, 15% in your employer fund to your pension fund, you still have another 12.5% that you can now contribute to a retirement annuity fund. So, in actual fact, it's opening up retirement contributions. Now, in fact, as I said, in my limited time, I can only give you an overview, but in your packs, you actually have these slides for you to actually examine. And you'll just see in these two slides in your packs that under the current system, the maximum contribution that could be paid on 500,000 rands worth of remuneration was 114,400. Under the new system, the maximum you'll be able to pay in is 137,500, and it reduces your taxable income. So, all good news. Now, going on to that second E, which is the build-up in your retirement fund. And this is also good news, because you can see there's no dividends tax, no income tax, no capital gains tax in your retirement fund. And on death, there are actually also estate planning opportunities in your retirement fund. There's no estate duty if you die before retirement on your retirement fund, and even if you die after retirement and say you're taking a living annuity where your dependents have taken the balance that's left over in cash. That is not estate dutiable and not subject to capital gains tax. So lots of estate planning opportunities. And for people who in retirement have an estate duty problem, okay, it's something to consider together with your financial advisor as to whether you should actually put a greater contribution into your retirement fund and actually save estate duty that way. Now, we've also said in John's presentation that the name of the game into the future is preservation. That is really one of the only ways that people are going to have financial sufficiency in retirement. As we've said, as you all know, the rule of property is location, location, location. The rule of funding viably via a retirement fund is preservation, preservation, preservation. And in the new environment, right now, you have to elect to preserve, okay? Because the default option is that you can take your money in cash. Okay, in the new environment, in fact, the default option is that you preserve, and you will have to specifically ask to take the money in cash. And the good news is that when you transfer from one retirement fund to another fund, the state acknowledges that this is a good plan of action and gives you a tax-free transfer all along the way to retirement funds, especially in the new system. Okay, now that's preservation, which we believe is the way to go. if you terminate service prior to retirement and you withdraw from the fund, your money will be taxed on this table. As you can see, only the first 25,000 Rand is tax-free, and then it goes up in different levels of 18%, 20%, and after the table is exhausted, an amount of 36%, which I think that you can see can be quite a punishing rate of tax. Now, this table is not as good as your retirement table. Okay, so that's why we really discourage people to use the withdrawal table prior to retirement. If you look at this table, you'll see, and this table and the previous table actually changed in the latest budget. Your first 500,000 Rand now of lump sum is taxed at 0%. Now, you all probably know that when you come out of a pension fund or a retirement annuity fund, you can take at least a third of your fund in cash. Okay, you're entitled to it, you're allowed it in terms of the rules of the fund. But in fact, the question is, and the advice that needs to be taken is, should you? Should you just because you can? Or from a tax planning point of view, is it better to use a great deal of that to buy a pension? You'll see on that table that also goes up in tiers of 18%, 20%, and 36%. Now, I'd also like to show you that the difference between using your full 1,050,000 on the withdrawal table and the retirement table is actually not advantageous, because in actual fact it's costing you another about 95,000 Rand. But people say also, what happens if I contribute more than I can deduct to my retirement fund? What happens? Do I lose it completely? And the answer to that is no. The legislation gives you three options if you over-contribute. Okay? It's not necessarily something that's a strategy, but sometimes it just happens. For example, I was in the Durban session, and someone said to me, they had been contributing to a retirement annuity fund, but now they are no longer employed, so can't get the deduction anymore. Should they continue to contribute? But on the other hand, they've still got a couple of years to go. But it was one of those life policy retirement annuity funds that Bruce will tell you about later. And unfortunately, there are severe penalties if you bail out early. So in this kind of situation, it was actually possibly better for this person to keep on contributing. But then what happens? Now, what does happen is that in years that you haven't taken your deduction, what you've contributed, you can actually carry over and get as a deduction. But if you are already contributing your maximum, you can also get the over-contribution when you retire from your fund. The first amount of contribution, say you contributed 100,000 Rand that you didn't get a tax deduction on. From your 1/3, the first 100,000 Rand will be tax-free, and then you'll apply the tax table. And then, this year, from the 1st of March 2014, they included a new provision in the Income Tax Act, and that is, if you decide not to take any lump sum, okay, and you decide to apply your retirement fund to purchasing an annuity, a living annuity, any kind of annuity, you will get, say you've contributed that 100,000 Rand after tax, the first 100,000 Rand that comes out of your living annuity or other guaranteed annuity will be tax-free. So lots of opportunities. Okay, now I want to come to that subject that I think is extremely important to consider for any retiree, person retiring, is how much of that 1/3 should you take as a lump sum? And the type of considerations that we have is that two important considerations. Tax is lower in retirement than at retirement or during your working years in the majority of cases. And in addition, one's tax threshold actually increases every year. Okay, every budget, your tax threshold will probably go up by inflation. Okay, what I mean by a tax threshold, it's the point at which you pay no tax, 0% tax. So if you're only drawing that amount of income from your annuity, should you be using a retirement fund table on lump sums that taxes you at, say, 27%? Okay, those are the questions. Now, I want to just reaffirm that in retirement, okay, your pension income is taxed at your marginal rate of tax. But it's also something that you need to discuss with your advisors, just understanding that in a living annuity portfolio, the build-up of that living annuity payment is actually tax-free in that environment. You know, people think that planning for retirement and growing their retirement capital ends the day they retire. That's not true, especially in a living annuity portfolio, because you place your money in a living annuity portfolio, and that portfolio also grows, and it grows tax-free. The only difference is there you're drawing money out. And another thing that I always have to just say again is that when one is doing tax planning for retirement, remember, tax is only one consideration when you're coming across these decisions. You know, naturally, if you have debt to pay off, etc., you might need to take more as a lump sum. Okay, don't be scared by that slide. I just want to show you why I'm saying that your tax actually reduces in retirement. This is how you are taxed. Okay, you earn your income, then you get to a point of taxable income, and then you apply the tax tables, and you get to a point which we call tax per tables. But that's not the tax that you pay, because we have rebates, and if you're over 65, which is generally retirement age, you're going to get 2 rebates, and that brings your tax down. And if you look at the budget booklet that you've got, you'll see that it says that people's tax threshold are those figures, as it is on the slide. But is that a true picture? Because in actual fact, you have other deductions and credits that are going to reduce your income. And from this year, people of over 65 go onto the tax credit system, and you get 3 potential tax credits, and this is just one, okay? That depending on how many members you have at your medical aid. And a tax credit is similar to a rebate, and that reduces your taxable income further and the amount that you pay tax. And although this is a very busy slide, and it's in your pack, so I'm not going to go through it, you will see that if you take all your tax credits and you take even your interest exemption, because you know that we get a certain amount of interest tax-free, for people of over 65, it's about 34,500 Rand. You can see in that middle figure, in that figure in orange, that your potential tax threshold is closer to 230,000 Rand if you bring those in. And I haven't even brought in that 30,000 you get when you actually when you dispose of a capital asset. So add another 30,000 Rand to that, and it brings it higher. So it really is something that one needs to take into account. Now, that slide just shows you what your tax rate would be on 500,000 Rands worth of income in retirement. Okay, now let's say, you might say, well, I would live on more than 500,000. Let's say you and your spouse were having 500,000 each. Okay, that would both each of you would have that tax rate. And you can see that it's around 20%. Okay, now think about that table. You've got 0%, 18%, 27%, 36%. Are you going to use the whole table when your tax rate in retirement is only 20%? Okay, so these are the things to consider. Okay, so now I've said to you at the beginning of the presentation that we have your tax-deductible investments, and then you have your after-tax investments. And I believe that financial sufficiency in retirement is by using a combination of both from a tax point of view. Now, let's look at some of the situations that we have. Now, as I said, a great deal of legislative change, and what the state does intend including from next year is a new kind of investment vehicle, which is a tax-incentivized saving product. Okay, you might have read it in personal finance. The state is actually going to allow you to take 30,000 Rand a year, place it in a savings account to a lifetime limit of 500,000 Rand. So each year you can take 30,000 Rand until you reach that 500,000 Rand. But the beauty of this account is that all the income and growth on this account is actually going to be tax-free. Okay? They say that they will increase the 30,000 Rand a year for inflation, but not the 500,000 Rand. And you're going to have up to 2 accounts every year, and it can go into equities and can go into interest investments. They're still considering endowment policies because they don't. If endowment policies are going to be allowed, it's going to only be if the insurance companies don't put hefty penalties on it. So that is still under negotiation. But look at this, a wonderful, also something to discuss with your financial advisor, that your first 30,000 Rand of disposable income might need to go into that account every year to help you on the road to retirement. Now, you can see a number of different kinds of investments, all have slightly different tax treatment, but the good news, if you look at that slide, is that the tax rates are quite low on those investments. There's dividends withholding tax of about 15%, which is not high, and then let's say capital gains tax. The great news for individuals on capital gains tax is the first 30,000 Rand of your gain every year is exempt from tax, but then you are actually only taxed on about 33.33% of the gain, which at your maximum marginal rate of tax is about 13.3%, an effective rate of 13.3%. So you can see, quite advantageous to not swirl your taxable income in retirement and give you more disposable income. Even endowment policies, although the tax rate in an endowment policy is 30%, the capital gains tax rate in an endowment policy is 10%, which is actually lower than your tax rate if you would pay on an investment in your own name. And the great thing about an endowment policy is the insurer pays the tax for you all along the way. So when you decide to take the proceeds, it's actually tax-free in your name. So it's not a tax-free investment. It's just that you don't pay the tax. The insurer pays the tax for you, but what it does is that you're not paying more tax in retirement, so it's not increasing your tax rate. Things like rentals and property are something to consider. Another kind of investment that you get, but again, this is not just from a tax point of view, it might be advantageous, but your financial advisor would have to tell you whether the rates are good at the time that you go into it, is something called a voluntary annuity, as opposed to a compulsory annuity. And this means that you take money, you give it to the insurance company. The insurance company takes your capital and instead gives you an income. Now, the difference between a voluntary annuity and a compulsory annuity is a compulsory annuity is fully taxable. A voluntary annuity the structure is that the insurance company gives you some of your capital back and only a certain amount of it is growth, which means that on a 5-year investment, probably about 90% of the return is tax-free. And then what do you do? Part of it goes into the voluntary annuity and part of it goes into, say, a unit trust or an endowment policy to buy back your capital, and then you can recirculate it again. So there are a number of tax planning opportunities that you can use with discretionary money. Interest. Now, interest together with this new goes together with this new tax incentivized savings product. Okay, the state felt that it wasn't fair to just give exemptions on interest. Okay, so what they're going to do is they're going to peg the value of the interest exemption. Okay, and they want to now encourage you to use the 30,000 Rand so that you'll get some kind of balance. So that interest exemption is going to be pegged. Please note that it's wrong in your books. So if you can just make a note that what's on the slide is the correct interest exemption. Okay, and those of you who are fortunate enough to have trusts, a loan account, repayment of a loan account from a trust is a wonderful savings opportunity because there's no tax paid on loan accounts if one can have set that up during one's working life. Okay, so as I've said, and what all the speakers have said, is that structuring your retirement right for tax starts long before retirement. It's a marathon. It's not a sprint. It needs to be fine-tuned all the way. And just to please have compassion for your financial advisor. Don't try and cause him to become a legend overnight. Because just to end off with the words of Einstein, Einstein actually said that the most powerful force in the universe is the power of compound interest. So it's your money growing over a period of time. Okay, there is no more powerful force, and if one starts early on, just the road to planning for retirement becomes really not an arduous task. So I'd like to thank you all for listening to me today, and please let me remind you that please SMS your questions if you have more in-depth questions on tax to that. We will try and answer it on the panel, and I will now hand over to my other speakers.